Welcome back to the Make It Count podcast.
I'm Marcus Mire, founder of Mire Group CPAs and the Total Control Accounting System.
And I'm Tyler Warner, small business owner with a lot of accounting questions. I'm going to let you tee this one up, Marcus.
Yeah, because as we were talking about it before, you're like, what?
Yeah, I could take a guess. You could
Okay.
you could give me 20 seconds to see if I
I'm
can
going to
get
give
it
you
right.
the topic. You take a guess. All right, the topic is cost segregation study. Go.
All right, cost segregation study. All right.
I wish we
and
had, like,
you
the
mentioned,
clock.
oh yeah, you're familiar with real estate. You should know what this is. So I'm
Yeah.
trying to think of why I should know what this is.
Yeah.
And is it a specific study?
You're down to like 7 seconds.
Oh my gosh. All right. I quit.
All right, cost segregation study. All right, so everybody wants to know, and look, I get it. Everybody
Oh, I think I know what this is.
All right, go ahead. Do I get to go, if it's wrong?
Sure.
Okay.
All right. I think is it basically like, not cash flow forecasting, but is it looking at like basically here's what option A looks like if you do this, and this is what option B looks like if you do this? And no? Okay. All
Not
right.
close.
All right.
Cost segregation study. It is where you buy a piece of property, a piece of real estate. Let's be specific. A real estate, a rental property generally, or your own building, and you depreciate. You have a study done to determine what parts of the building qualify for taking faster depreciation.
Oh, right.
So, really cool tool for people in real estate. I would say either owner occupants. So some qualifiers here, or because there's some ways you can take your operating real estate and net it with your operating business,
Yeah.
or you have other real estate ventures. So I want to make sure that's clear.
We talked about this before, I think,
think
because
so.
it was like,
Like me and you,
yeah,
on the podcast.
It might have been like just like a quick aside
Yeah.
one time on the podcast, because now that when you mentioned like getting that study done,
Right.
It was for like if you buy like, let's say air conditioners,
Correct.
or if you do stuff like that, you can depreciate 100% of that
Right.
ahead of time. Whereas like most of a building, like if you just buy a house or a rental house, you can't depreciate all of it up front. You have
Yep.
to do it. There's a formula for it over
Yeah,
like
you're
20
right.
years or something like that.
You're 100. That's the gist.
Boom.
Boom. So I retract my
Yeah.
buzzer.
Okay.
Okay.
Thank you.
Yeah. You needed to have the.
I'm
pump
more
primed a
familiar
little
with
bit.
the acronym.
Right. You're more of a cost seg guy.
Yeah, exactly. Yeah.
When I said cost segregation
Yeah,
study,
I
you're
was
thinking,
like, what are you talking about?
oh, he
Yeah,
means cost seg.
Oh, yeah.
Yeah.
Gotcha. You should
right.
have said so.
So, all right. So, I would tell you like TikTok and then people on Twitter, and they have this community on Twitter called the hashtag tax Twitter. And it's a bunch of accountants, CPAs. Like, there's really actually a pretty cool community of people like helping, sharing ideas, thinking through. But one of the things they love to do is just rail on and freaking dunk on people with these crazy tax schemes. Because everybody's pitching them. But one of the legitimate things that I think people think is a tax scheme is a cost segregation study, I'll be honest. And so a cost segregation study is where, there's a magnitude to it, right? You're not going to do this on a $80,000 2-bedroom, 1-bath house. Like,
Okay.
so it's kind of got to be the juice has to be worth the squeeze kind of thing. Because you're paying a consultant to go into your property and say, hey, what portion of this property is the structural components? Like, what's holding this whole structure up? Mm-hmm. That is what you refer to. That's I can't depreciate that fast. So in a residential rental, that portion is you depreciate over 27 and a half years. So you can already see you're not getting that much each year. Mm-hmm. On a commercial building, that portion is over 39 years. So you could see why you would want somebody to come into a major building purchase and say, well, let's just say you bought a building for $2.5 million. You can't depreciate land, so let's just start.
Right.
So there's always an allocation to land. Generally, what the assessor says, or if you don't have that, we use a rule of thumb. We say 15% of a real estate purchase is land, absent something to the contrary. Like, no, we know that land's worth a lot more or a lot less. Okay. So let's just say $2.5 million. 15% land would be $375. So what does that leave you? 1.825 left. Okay. Let's just call it 1.8. Mm-hmm. Of the 1.8, you would have somebody come in and say, well, only 1.3 relates to the structure of this, and they do it based on what's current cost to rebuild that, all kind of ways. I don't know all the ins and outs of that. What I do know is they then say on the remaining 500, well, here's the stuff that falls into 5-year depreciation, 7, 15, and so on. And those 5, 7, and 15 also qualify for bonus depreciation, which is a immediate write-off. So you don't have to wait 5 years. So just things in the 5-year category can be written off in the first year.
Okay.
So that's what's happening when you do a cost segregation study. So you can imagine if you own a bunch of rental properties that are doing really well, like producing a lot of net income, and then you go buy one, and especially gets better if you financed it, right?
Right.
Because let's just say you financed $2 million of a $2.5 million purchase. You could get these huge deductions, and you hadn't even maybe made a mortgage payment yet.
Right.
You could just you could buy it in December 20th. Like we're on December 14th here. You could close on a building before year end. Cost segregation, as long as you placed it into service, which means used it for its intent, whether that's marketed it to rent, had a tenant, or moved in it yourself. Boom. Cost segregation, and it can be done in retrospect, right? You could have somebody in February come back and say, oh yeah, of your 2.5, I think 400 is faster. Huge depreciation write-offs that you could then take, that make that property lose money on paper, right? Rental income minus all related expenses, including depreciation, produces a loss. You can then take that loss and use it to offset or negate other income, other rental income. The reason I'm being specific about that is because one thing that's a trap for people, and look, with so much information out there, there's also misinformation, and there's also not nuance. I think that's really what the tax Twitter community is hitting on, is that people come up and give advice, but they don't give nuanced advice because the platform that just doesn't allow for that. It's a soundbite. Yeah, it's 140 characters. It's a minute video.
I haven't been on Twitter in a while.
Whatever it is.
Yeah.
It's a soundbite. It's a quick hit video. There's no room for nuance. That's where professionals live in nuance. Like you have a CPA, they know nuances. So here's the nuance. If you do that on a building and produce a loss, and you make too much money in all your other sources of income, you can't take that loss. Now, it doesn't mean it goes away or it's not deductible. It just means it gave you no benefit currently.
Yeah.
It goes out into the future and you can use a little bit up and there's other rules. But my point is, you got to know the fact pattern. You got to either be really in real estate where you got income you want to offset, or you own a business and you could potentially group the two activities together. There's the rules around grouping non-rental with operating. Let me back up. A non-rental, which will be your operating company with common structure. Okay. You own you had a marketing business, you have a marketing business, you buy a piece of real estate, you put that in a different company and you rent to yourself. It's called a self-rental.
Gotcha.
You could group the two together such that if this company, the rental company, produces a big loss, you could net the two activities and still get the benefit of that loss.
Okay, gotcha.
So I'm giving people just the background to say it's nuanced.
Yeah. Who are these guys that do they have a license from the government to come and do these audits, or is it just like are they like appraisers or?
That's a good question. I'm looking here at a common one. We've used these before. It's a company called KBKG. Let me see. That's one of their FAQs. I'm glad I had that pulled up. It says here. This is a good question. Will the company be available if I get audited? Which I think is kind of what you're pointing to. And they say any company can give you a cost segregation report with the results that save you money. The real question is whether it will stand up to IRS scrutiny. Okay, hold on. I'll just kind of get more. But basically what they're saying is they'll stand behind the report. I don't know if, there is a CCSP designation. Hold on. This is getting good.
Yeah,
this is like real live radio here.
Yeah, I'm just thinking like in real life, like I don't know that I understand the difference. Like I'm thinking, okay, you buy a restaurant.
Right.
Well, is the kitchen part of it, or is the tables and chairs, or you know what I mean?
Well, normally you don't buy real estate with movable property. Like normally you don't buy. Now sometimes you do. Normally you don't buy an office with desk in it, to give an apples to apples comparison. But you do buy an office that has flooring in it, lighting, cabinets, carpet, when I say light fixtures, all kinds of different things that qualify for faster depreciation that you just normally, absent knowing that, you just say, well, that's 39-year property. It must be. This is where, and I don't have an answer to your question. I'm looking to see, it says here,
And so they're just taking the value of those things, and
They
then
have formulas.
that's the report they're giving.
Yeah.
Is here's the estimated value of it, and everything that qualifies for faster depreciation.
Correct.
And then this report is
This
they're
report,
qualified somehow.
they are, and I'm reading here further. They say that there's an audit technique guide. Like the IRS puts out these guides that say they give their auditors. Here's how you audit a situation, and these guys are saying they base their reports on producing information that would satisfy the audit technique guide.
Gotcha.
So essentially, I don't think there's a license. Is a really good question, and I hadn't thought of that.
So I could become
You
an
could.
auditor tomorrow.
Yeah,
Get ready, folks.
let's go.
I'm about to start snooping
Can you
around.
can you do that in flip flop?
Absolutely.
You're doing more of the property
Yeah,
down
that's
on
that's our whole
on
thing.
38.
It's like, are you tired of the stuffy, uptight?
That's funny.
I forgot the name of it. Segment. What is it? Yeah, I forgot the name of what we're talking about.
Cost segregation.
Cost segregation
Cost
analysis. Yeah, cost seg analysis. You need a laid back, flip flop wearing. Yeah,
You're their guy.
yeah, that's right.
Yeah. So I mean, you could really benefit from this, and it's a great tool. We did a client last year. They
Help me understand what's the quick and dirty differentiation? Is it just
like when you would do one.
No, not when you would do one, but I'm just thinking of how do you know what's what?
Well, that you're relying on the expertise of the people that do this.
Okay,
to know what's what.
But you kind of need to know a little bit to even know if it's worth engaging somebody.
Well, I would say this. All buildings have 5, 7, 15-year property. Most people just don't take the time to allocate to it. They take the default, which is the conservative approach to 27 and a half year for residential or 39 year for commercial, because it's not worth it to them to go get somebody to mine out, because you might pay $5 to $7 grand for this study.
Yeah. Now, what is it? Does it work at all for improvements? Meaning, let's say you buy the building and you're like, all right, I'm going to buy a whole new air conditioning system, or I'm going to go super eco-friendly tint on all the windows or whatever, make it all, do all of that, update all the windows, and then hope that the depreciation that I can get on all this would offset the investment. Almost kind of like a write-off the mind, but is that kind of another angle on this, or is it?
Kind of. This is what I'll say to that point. If you make improvements to a property, you know what you're paying for the improvements.
Right.
So you don't. There's no need for a study. If you go and make
that's just a question of whether it qualifies
correct.
for this
depreciation. If you go, I'll give you an example, and enlarge your building.
Okay.
That's structural. Absent a report that says of that cost, we know some of it happens to be flooring, this and that and the other, you're going to just say that's structural, depreciated over 39 years. But if it's an improvement, like you fixed up the kitchen or you did some remodeling, you're going to know there's a class of property called qualified improvement property that does give you bonus depreciation. So the way I would think about a cost segregation study is it's on the purchase of an existing building. If later you improve the property, you would then depreciate that subject to the improvement standards. Mm-hmm. But it's trying to mine out what would otherwise be not fast depreciation on a building that's existing, or a house that's existing. Like, hey, I bought this thing for $1 million. I don't know what the previous owner did. I'm just buying it right now as is. What can you tell me of the $1 million would get fast depreciation?
Gotcha.
Then if in 2 years I go and update all the windows, that's subject to a different standard.
Yeah.
I know exactly what I paid for that.
So most of us are familiar with normal depreciation formulas, the tables, right?
Most people are.
Well, most people that have been listening to this podcast, we know that there's at least a formula for the
Correct.
tables or whatever, and
Yep.
you keep track of that. I'm assuming fast depreciation is just one speed, which means that year, all of it, 100%.
Generally, yes. What you have in terms of when you say fast, the tax code calls accelerated.
Okay.
So accelerated depreciation generally over the last few years, we've been in one of the categories is bonus depreciation.
Okay.
Which means I buy something for $1,000, I can take a bonus. And bonus for 2022, which it changes in 2023, bonus depreciation for 2022 was 100%. So $1,000 purchase, write off $1,000 because it's 100% of 1,000 immediately. That same purchase in 2023 is an $800 write-off immediately. The remaining $200 subject to the tables.
Oh.
Okay.
So you can only do 80%.
80% bonus. The rest subject to the tables. The $200.
Okay.
But so that's another consideration, right? Because bonus changes. Now you do have what's called Section 179 that does allow writing off tangible
I
property.
forgot about Section 179.
Yeah, no, I figured you were going to get to that.
Yeah.
Section 179 does allow you to write off things 100%. So bonus and Section 179 are kind of do the same thing, but there's different rules. And it's outside of this podcast.
Yeah. Are there times where business owners are are there scenarios where you're like, man, check this out now because you're missing out? Is there a warning to business owners to say like, hey, if you do these things, when you buy a building,
Yeah.
obviously that sounds like a good time to
Yeah.
do it. When you buy a business, probably a good time to do it. Are there any other times that are like, hey, this is the time it's worth doing this?
You know, I mean, I can't really think of another one other than the when you buy, and is it material, right? I mean, again, we kind of get back into the if you buy something for $250,000, is there that much meat on the bone to do this? So the trigger generally is: did you buy something that's material, in value, and do you think there's enough to get you some quick depreciation? So like let's put some numbers to this. Let's just say you buy something that you have $1 million of depreciable. So let's just say you buy something for 1.2 and the value of the land's $200,000. Let's just say so $1 million is what's on the table. $1 million over 39 years is roughly $25,000 a year. $1 million divided by 40 would be 25. If you did a cost segregation study, so that's a $25,000 of write-off every year as an expense for 39 years, but call it 40. If you did a cost segregation study and they deemed $300,000 to be what you could a 5, 7, 15-year property, $300,000 write-off in the first year. That's $275,000 different. That's huge.
Yeah.
Now, admittedly, you only have $700 left, and that goes out into the future over 30 years or 39 years. But shoot, you got so much time value of money on the front end of a $275,000 difference now that saves you $100,000 in taxes. Like, you start off in a great position.
Right. And your depreciation, I don't want to mix up the words, but it rolls over as a credit, right? A deduction. So
It doesn't roll over. I
almost said it's credited on your account as a deduction. Correct. But I didn't want to use the word credit because I don't want to confuse. Yeah. But I mean, just mean like, it's still there. The balance goes down, meaning like if you have this deduction that is like you said, $1 million or $250,000 deduction available, right, but you only have. Am I confusing it with credits again?
I don't know. I'm trying to figure out where you're going with this.
And let's say you owe $200,000 in taxes.
Right.
Well, that deduction.
That's a credit.
That goes against your basis,
you're
right?
Thinking
yeah. All right.
This is like Tyler's smorgasbord of accounting terms.
I'm just,
It goes against your basis, useful life.
Okay, all right. I'm back on track.
Recapture. Right. Now, one thing I will say to this, just we got to complete the picture here. If you do this, it's probably a property you're going to hold on to for a while. Mm-hmm. So let's give the $1.2 million example. You just took $300,000. We said of the, let's just say you could take $300,000 and another $10,000 on the remaining 70 on the remaining 700. Well, now you've lowered your basis by $310,000. If you go and sell that thing the next day for $1.2 million, you got a $310,000 gain because you've written it down.
Oh, wow.
So there's ways around that. You could do a 1031 exchange. You could sell that and buy another. It's like a what's called a 1031 exchange. It's a replacement. But don't leave this conversation thinking you're going to do this and in 3 years be like, all right, I'm good. I'm going to sell this property, which you could. You're just going to basically recapture. Another way to say you're going to record as income all that depreciation. You have to give it back.
Yeah. Okay.
Yeah.
Well, it sounds like it's a good tool for kind of like, right, it's like you recommend at the end of the year, don't go out and buy stuff you don't need
Correct.
for the write-off,
Yeah.
But if you're buying a building, if you're buying a business, if you're doing that, definitely give this a look.
It's a sweetener. Tax is a sweetener to the deal. It's not the whole deal. You run your business for cash flow and efficiency and to run a good business. You want to be tax efficient. There's no question about that. But you don't want to make moves 100% for tax reasons because, to your point, if I buy a $100,000 piece of equipment, it really only saves me $35,000. I still got to pay $65,000.
Yeah.
I didn't make out any better on that deal. Now, if you were already going to buy the $100,000 piece of equipment, if it made sense economically and from an operations standpoint, you can pay the note and you need it for your business. Well, then the tax becomes a sweetener to the deal, such that you might say, well, I know 2022 was a great year. 2023, we don't think it's going to be so good. Let's buy it in 2022 because we need it anyway. Mm-hmm. That's the kind of things you need to be thinking through a tax. Is it in the right year? Do I need it? Sweetener to the deal kind of concept.
Yeah.
Yeah.
Gotcha. Well, good stuff. As always, you can find more resources at mire.group, and maybe you'll find some people that can do these studies if you need.
We don't do these studies. Just
Right.
disclaimer. We would send them to a qualified
Yeah.
company. Like I said, this was it KBKG?
And they probably won't show up in flip-flops.
They probably won't show that. I think that's the one
Guaranteed.
thing I know. Yeah.
Yeah. All right. Well, until next time.
See you guys.
Yeah.